In today's Property Insider video, Dr. Andrew Wilson and I discuss the intensifying rental shortage, which is more bad news for tenants. We have a look at what's really happening to housing affordability for first home buyers, and we discuss all the property news including inflation and interest rates. If you want to keep up to date with what's happening in our property markets, please subscribe to this YouTube channel and click the little bell icon so you can be notified each time a new show comes out. There's been lots of news in the world of property, economics and finance over the last week. Australia's unemployment rate technically fell last month, but with rounding of figures, it still remained at 4%. But this has only created further speculation of when the Reserve Bank's going to start rising interest rates, particularly in light of inflation in the United States that rose to 8% last week. And even though the Reserve Bank once again left official interest rates on hold, 3 of our 4 big banks raised their fixed term interest rates by up to 0.5% last week. In today's Property Insider chat, I'm going to ask Australia's leading housing economist, Dr. Andrew Wilson, his thoughts on these matters. Plus, we're going to explore his latest research on what's happening to first home buyer affordability and our rental market. Hi, Andrew.
Good day, Michael, and happy Easter to everybody.
Andrew, we're experiencing some interesting times, aren't we? Consumer sentiment's now falling, and that's not surprising considering all the bad news in the media. We've got a war overseas, a spectre of higher inflation, higher interest rates on the horizon. All this talk about housing affordability and a housing market crash. So what's your take of what's happening in the world of property?
Well, firstly, we've had some economic data out this week, it's Michael, and that's the latest labour market data, and that was the data for March. It was interesting in a sense that we're maybe seeing some sense of a stabilisation in our labour market now. Of course, we are still going through that adjustment period that we've had the roller coaster of COVID impacting the data in terms of unemployment rates. And unemployment rate was at 4%. It did improve. Employment was up. Unemployed was down. So, but with the rounding effect of the data, it meant that the headline rate at 4% remained the same. I'm not sure we're going to get a more of a significant decline in the unemployment rate going forward, Michael. I think we've perhaps, and that doesn't mean it won't fall, but I don't think we're going to see any sharp falls. And I think conversations around potentially a 3% unemployment rate are probably a little bit off the mark, particularly given we've seen more of a stabilisation in the series with the latest data. Participation rate remains at around the record high of 66%. A little bit more participation. New South Wales participation rate is still below its record highs of last year, but that means we're really taking the most we can out of the population in terms of being active in the workforce. So again, just another sign that perhaps the labour market is steadying at what is a very good rate, of course, 4%. And I think we can remember that 4% number quite effectively. It's the lowest we've had since 2008 with the monthly reporting that the ABS does. It's had a lower rate with the when it used to do the quarterly reporting. But jobs are still growing. The number of unemployed is still falling, but not at sharp levels or the sharp adjustment levels that we've seen. And of course, the whole purpose of focusing on the unemployment rate in terms of property market, Michael, is in respect to its impact on interest rates. And theory is that once we get to that baseline full employment rate, it will start pushing up wages, which will then work to push up prices, and we start getting that inflation effect from low unemployment and a shortage of labour. So the real key to all this is whether we are starting to see an increase in wages as a response to what is, I guess, pushing towards a full employment labour market. The first lot of data, I guess it will be capturing what's happening in the labour market in terms of low unemployment rate, will come out in the second week of May. So that's coming quite quickly with the wage index data. Of course, that has remained quite flat since the GFC. Wages growth picked up a little bit over the December quarter to 2.3% annualised. And the Reserve Bank's quite clear about it needs to see a consistent period of higher wages growth before it considers raising interest rates. So that'll be the first, I guess, test for that low unemployment is driving higher wages in just 3 weeks' time. But at the moment, I guess we've all got to celebrate the fact that we have a strong economy and just wait and see whether it's, according to the textbooks, starting to drive wages up and therefore driving concern from the Reserve Bank in terms of a wages prices spiral potentially. And that, of course, is the process that will activate higher interest rates. We had the US inflation data out last week also, Michael, for March. That was another high number. Unlike Australia, wages in the US are growing quite quickly as well. So they have more of a scenario for wages fueling inflation than fueling wages, etc. And that's why they've already raised interest rates and likely to continue to do so. The underlying inflation rate, Michael, which takes out volatile issues such as food and oil, was a little lower in the US over March. It was 0.3%, which is still quite high, but some signs there that underlying inflation in the US is easing slightly. Obviously, a significant driver of higher inflation globally is the price of oil. It's interesting that oil is now 25% off its peaks, has picked up over the last week, but in overall terms, it's tracking at around about 25% lower than its peak. So some good signs there in the longer term, but a lower oil price will take some time to work its way into reducing inflation, Mike.
Well, Andrew, looking at property, though, while the housing markets have slowed a bit, they're not growing as much as they did last year, and they couldn't. Rentals are still rising, aren't they? And I know you're keeping a careful track of that, and the current rental shortage is more bad news for tenants.
Well, there's no sign of an easing in what are across the board tight rental markets. We've had two particular sub-markets, Michael, that have bucked the trend of a shortage of rental supply through the COVID period. And of course, we know those CBD rental markets, unit rental markets in Melbourne and inner suburban markets around the CBD in Sydney. Of course, we know the reasons behind that. High levels of supply through the building boom of the last 4 or 5 years, which of course has ended. And of course, the lack of demand once we had closed borders from students and business travellers and tourists has meant that there were high vacancy rates, those particular submarkets. But we've seen this year, particularly, Michael, that there's been a significant soaking up of those vacancies, inner city apartments in Melbourne and Sydney, although vacancy rates are still notionally above 2% in Sydney in those areas and just above 3% in Melbourne. They're coming down quite quickly. And I think that's just a question of people having to make choices because there's no alternatives in terms of a lack of particularly houses for rent. But house rents are rising consistently in all capital cities at around about 10%, and in some capitals more than 10% per annum, which is bad news for obviously for tenants. And in an environment where prices are rising as well, in that inflationary position that we have, higher rents, of course, are another blow to household budgets for those tenants that are sort of caught in that environment. Really, there's no sense that this will be fixed in the short term, Michael. We will have, with open borders, more demand, migration resuming, international student numbers coming back in, more demand for rental properties. And that will mean, again, with an already existing shortage, that will mean higher rents. But vacancy rates particularly for in all capital cities, but particularly for houses, are really pointing to almost a lack of rentals available, certainly very low numbers of properties available for rent, particularly houses. And that, of course, will continue to place upward pressure on rents, and cost of living issues are certainly going to be a significant factor for those that are in that rental market. And not sure we've heard much from the government and the prospective governments about the state of the rental market, which, given it's around 40% of households, I think should be getting a little bit more attention, with the issues of skyrocketing rents clearly affecting a significant proportion of the population.
Sure, we're really in a rental crisis, aren't we? And many of those tenants wanted to aspire to be first home buyers, yes, and they're feeling the pinch as well. They're getting it from all sides: higher property prices, higher cost of living, higher rentals. I know you also track housing affordability at My Housing Market. What does your affordability index show?
And our latest one, no surprise, of course, has seen a collapse in affordability for first home buyers over the past year. And when we match that against the level of the number of first home buyers, no surprise, we've seen a significant fall in the number of first home buyers. Affordability constraints, which have come, of course, from higher house prices, will drive first home buyers out of the marketplace, which we're seeing. They can't save at the same rate that house prices have been rising. so that tends to marginalise them. Of course, a number of the government initiatives that have been directed at first home buyers, particularly the first home buyer deposit scheme, that's run its course. Certainly affordability is driving first home buyers out of the market. They don't have the trade-in to bring into the marketplace as owner-occupiers have, so they can't keep up with prices growth with their trade-in price rising as a consequence. And of course, we know wages growth is still particularly benign. So eventually high prices will affect first home buyers. But of course, the other problem is those first home buyers that are aspiring to get into the housing market are now faced with the double whammy. Well, I guess what the positive is that prices growth in Melbourne and Sydney is easing, but unfortunately rental growth is very strong. So that limits their savings capacity. So cost of living issues will confront prospective first home buyers getting into the marketplace. We've had a period of very strong first home buyer activity, which came through a period of lower prices and also as a result of a number of stimulus packages directed to that group. But look, on the positive side, the government has announced an extension to the first home buyer deposit scheme, but I think at the margin that will certainly improve first home buyer activity. But I think the problems are more generalised than that, Michael, and particularly given strong investor activity, which tends to crowd out first home buyers, the potential for more demand coming into the marketplace, not just for buyers, but for renters from the resumption of migration and those international student numbers. It's even though prices have stabilised and affordability is likely to improve as a result, it's still a tough ask going forward for first home buyers. And the point is, of course, that prices haven't fallen, particularly in Melbourne and Sydney. They're just really steadying now and still remain quite high.
Now, clearly, first home buyer affordability varies from state, and this chart shows, not surprisingly, that the two big capital cities are the least affordable. In other words, your index is higher. The higher the value of your index, the less affordable things are.
Yeah, well, no surprise. That's what we see generally with affordability, Michael. All we have to do is look at the comparisons in median prices between the capital city market. Sydney's still tracking above $1.5 million median, which is double that of Brisbane, which means it's a lot easier to get into the market if you are in those smaller capitals in terms of prices. The best options really, again, are the unit market for first home buyers in terms of price entry points. But it's that, and of course we had the most growth in Melbourne and Sydney also over the last 2 years in house prices, although Brisbane and Adelaide are certainly still rising quite strongly, and that has meant that it's been a tough ask for first home buyers to continue to enter the market with prices growth as strong as it's been in Melbourne and Sydney. And of course they will confront those same issues in Adelaide and Brisbane as prices are rising quite strongly there as well.
Now, when you look at the size of home loans, there's that quiet achiever, Canberra. One doesn't talk a lot about it, but boy, the average home loan size for first home buyers is bigger in Canberra than in Victoria.
Yeah, that's right, Michael. And Canberra is clearly an undersupplied housing market. We know that it has a very restrictive supply line for land, for new home and land package, and that means, of course, prices are higher. But the offset to that, of course, is that because you have to pay more, or the average loan is higher, incomes in Canberra are also quite high, particularly in the lower demographic, which is obviously typically first home buyers. They have an advantage in terms of their income levels compared to other states. So that helps them, of course, afford a higher loan, but it does show that that's a pretty expensive market for first home buyers, that Canberra market.
Well, lots happening in the property markets, and there's lots more news coming up. So I look forward to catching up with you again next week, Andrew.
We're going to move through what's typically a pause period, Michael, April. We've got an Easter's come later this year. I guess once we move past Easter, we can really get a sense of the underlying nature of our housing markets because we've got our holidays behind us. Of course, Anzac Day coming up as well. We've got the election campaign. Not sure that's going to have much of an impact on our housing markets as there's no significant policy issues directed at the housing market. But nonetheless, it'll still take the best part of a month, Michael, for the dust to settle and for us to, I guess, look back and really reflect on volumes and values from our housing market. And that'll be towards the middle and end of May. And then, of course, we've got June and all that speculation that we'll get an interest rate rise in June, which is certainly going to be a very interesting period going forward.
Lots of fun ahead. Look forward to catching up with you next week, Andrew.
Yes, see you, Michael.